Good morning, everybody. Welcome to our third study group session. So thank you for attending, to all of you Sunday morning financiers. Love to have you back. For those of you who are attending for the first time, the last two sessions were about investing in the stock market, but don't you worry, because we will be doing it again eventually in the future. So I'll just wait for a minute to make sure everybody is going to join in. All right, let's get started. It looks like quite a few of you are attending today, so that's great. I guess doesn't have a lot of alternatives for a Sunday morning. I love that. My name is Chris Manfre, and I'm one of the lead instructors at the American Institute of Finance, and it's my pleasure to walk you through this material. Today we're going to talk about pricing stocks. And I have to say there's a lot of confusion very often about how we do this, and even textbooks are a little confusing sometimes on how we can price stocks. And I think this goes well with the fact that we looked into investing in the stock market during the last two sessions, and now we're asking the question, well, what's the right price? So if I go to the next slide, the first thing I want to talk about, and feel free to actually send questions, write questions in the box, it is pricing versus valuing. There's a lot of confusion sometimes about this. What is the difference between price and value? Well, very simply, price is what you pay and value is what you get. And the idea is that price and value will always be the same, will coincide only if the market is perfectly efficient. So in other words, if the market recognizes at every point in time the value of a particular stock and translates it into price, okay? But we need to be careful, because when we say about pricing the stock, very likely in reality we're valuing the stock, right? Above all, if there is a discrepancy between our number and what we see, for example, for a publicly traded company, what we see in the marketplace. Okay, so keep in mind price versus value, and we'll talk more about it throughout these 30 minutes together. So going to the next slide. Now, another very important aspect of pricing the stock or valuing the stock is to recognize exactly what we're talking about, right? So this is a stylized balance sheet. So you can see on the left side that rectangle that says business enterprise value. So that would be the value of all the assets of a corporation. And that would include cash, account receivables, inventory, property, plant, equipment, and other intangible assets such as trade name, patents, and so on and so forth. But when we talk about stock and we talk about pricing the stock, we're just looking at the equity component, and very often just at the common stock on the right side of this stylized balance sheet. Again, this balance sheet is different from an accounting balance sheet because it is about market values. It is not about accounting entries, okay? So you see that equity is basically what we call market capitalization, which is the price per share multiplied by the number of shares outstanding. We have a few ways, a few metrics that we can use in order to price the equity component of any company. And you can see that I illustrate those down below. Let me actually get my pen here so I can better show you. So down below here, we can price the equity component by using dividends and levered free cash flow and earnings, right? So, and I will walk you through the use of all these three metrics. Again, dividends, levered free cash flow, and earnings. And these metrics are good for valuing the equity component. If we were interested in valuing actually the left side of this stylized balance sheet, the business enterprise value, we would actually use a different metric, which is called the unlevered free cash flow. The unlevered free cash flow. But for now, we're not interested in that because we're just concerned about pricing the stock. Okay. All right. So moving on to the next slide. Okay. So this is the first metric. I talked about dividends, right? To price the stock or value the stock. And this is what you typically find in a finance textbook. Although it's not very clear how you can actually use it in practice, and I'll show you a practical example on how this can actually be done. The idea behind this, the dividend model, so-called dividend model, is that any stock should be worth all the dividends that will be paid, right, in the future, discounted back to present. Again, if you buy a particular stock and this stock pays dividends, all those dividends discounted back to present should correspond basically to the price per share of that particular stock. Now you can see that we have the model here indicating the different dividends over time. So dividend 1, dividend 2, dividend 3, and so on and so forth. Obviously, it's very difficult to anticipate what the dividends will look like, and that's the biggest challenge between the theoretical model, dividend model, and the practical reality of pricing the stock. We also have a model that is looks just at the constant dividend. In other words, I don't really know what those dividends are going to look like going forward, but I can assume that one particular type of dividend will be paid in perpetuity by the company, and so that allows me to price this particular stock. This model does not assume any growth, so no growth for this constant dividend. The last bullet point is about a model where we have a constant rate of growth, right? And that would be indicated by G here, and also the fact that this dividend is D1, right? D1, not just D bar as I had in the previous bullet point. Okay. All right. We'll see in a moment. I will give you some examples on how this actually works in reality, as we will get some numbers and we'll start having fun, calculating some of these prices. Okay. So let's move to the next metric in the next model. And so let's go to the next slide. So I told you that another metric that we can use is actually free cash flow model. You will see that all these models are basically exactly the same. So the only thing that changes is really what we have in the numerator. So you can see that instead of having a dividend now, we have a free cash flow. Why? Well, as you can understand, nowadays, many companies don't pay dividends. So when the dividend model came up a long time ago, basically most companies were actually paying a dividend to the shareholders. But nowadays, we have lots of companies that just pay a little bit of dividends or don't pay a dividend at all. So how could we possibly price the stock of those companies? Well, one way around it is to look at the free cash flow that could be used to pay dividends going forward, whether it is used to pay dividends or not. And so we can rely on the free cash flow model in order to estimate the price of a particular stock. Please notice that this is called the levered free cash flow, which is different from the unlevered free cash flow, which I mentioned before actually pertains to the valuation of the assets of the company, not the equity component of the company. And so again, the model is very, very similar to what I showed you for the dividends. It's just that, as you can see in the numerator of every formula here, now we have free cash flow referring to the levered free cash flow rather than dividend payments. Now we can move to the next slide. And finally, the earnings model. Why would we use earnings? Well, for one reason is because we know that in the long run, earnings and free cash flow should coincide, should converge to one another. So earnings could be a proxy for the cash flow that is going to be generated by the company going forward. So you can appreciate also in this case that we just replaced the numerator with earnings rather than dividends or free cash flow. So it's the exact same formula, but instead of dividends and or free cash flow, we have E for earnings, right? And again, we have the constant earnings, or we have a growing earning going forward. We'll see that probably the growing version of every model is preferable to any other model. So again, to recap, we got the dividend model, the levered free cash flow model, and the earnings model. But let's see how this actually applies in reality, right? The book is always a little dry and leaves us with a lot of questions in case we want to actually use this particular or this different types of models to price a stock. So since I like coffee, I would like to look at Starbucks, for example. So let's go to CapitalIQ, and again, you can go to the database of your choice. I use CapitalIQ, but you can go to Morningstars, you can go to Yahoo Finance, and many others. So the first thing we want to look at is what the price per share was on Friday, and we can see up here, that the price per share closing on last Friday was $74.29. So we'll use that as a point of reference, right? So we're assuming that that is the correct price for Starbucks per share at this point. Well, now let's start from the dividend model. So let's go to the income statement, and let's just collect that piece of information with regard to the dividend. So if we go here, we should be able to find the dividend per share, which is $1.59. Common dividend. Okay. Let's go down below. Let's see if I can indicate it for you. Well, we can collect the preferred dividend. Let's see. Okay, so the dividend, cannot locate it here. Common dividend, there you go. The common dividend, the last one, is 1801.6. So I'm going to write it on the side here. 1801.6. And this is in total. So we'll have to divide this by the number of shares. So let's see what the number of share is. We can go back to the tier sheet. So shares outstanding, you can see there 1168.1. So I'm taking notes. Okay, so now let's use this information and let's go to an Excel sheet. Okay, so we can write here, so common dividends, number of shares, right? So let's write our numbers, 1801.6. We have this number of shares. Everything is in millions, by the way, so these are big numbers, right? So dividend per share. Okay, dividend per share. So we just divide the total common dividend paid, and we obtain $1.54. So this one is actually in actual $1.54. So now if we want to apply the dividend model, we need to have a different, also we need to have the cost of equity for Starbucks. Now I will cover this in another study group session. So for now, just take it for granted what this number is. And I do know that this number, which I call K, is probably about 6.25%. Okay, so this would be the cost of equity. Again, we'll cover the way we can do this in another session. We also need to have some level of growth going forward, and we can estimate that the growth going forward will be 2.5%. Again, we can refine this particular metrics, right? Okay, so now let's use the model, and let's see what the price is going to be. So we can call this P0, as I called it in the slides. And so we're going to do 154. Well, first let's assume that 154 is going to be constant forever, right? So we can just do that divided by my cost of equity. And I obtained $24.68. Now you can see that $24.68 is really very, very far from our price per share of Starbucks at $74.29. So not very exciting. Maybe we're not very close to what the price or value of Starbucks is at this point in time. You might say, what is the reason? Why is the model seems to be far away? The result that we get are so far away from the current price. Could it be that Starbucks is overpriced at this time? Well, it is a possibility, but very likely I can tell you that it's unlikely that Starbucks stock price is overpriced by almost $50 per share. So very likely this model right now is not yielding something that is of interest. So this one would be actually the constant dividend. Constant dividend. Now let's have the model with the growing dividend, and let's see what we get. Growing dividend. Okay, so now we're going to do the same thing, but we're going to have a growing dividend. So we're going to grow this 1.54 dividend. We're going to grow it by the 2.5% that we assume being the long-term growth rate. So we take our dividend per share $1.54 and we multiply by 1 plus 2.5%. So there you go. So my dividend going forward, or next period basically, will be $1.58 instead of the constant dividend, which I assume to be the dividend the previous period, right, at 154. Now I have to divide this dividend at time 1 by the cost of equity minus the growth rate. Okay. There you go. So you see that now we get something a little bit more reasonable, right? We get $42.16. But again, the price per share, let me write it here. The price per share of Starbucks is actually, we said, $74.29. Right? So this is the price per share of Starbucks on Friday. Okay. I see a question, where did I get the cost of equity? Well, it's a great question, right? It's a great question. This is manna from heaven, as we say in academia for this particular session. So this would be the return required by investors in Starbucks. And one way of determining the cost of equity is actually using CAPM, the capital asset pricing model, right? CAPM. But we don't have enough time in this session to go through that, so just take it for granted for now, right? But in another session, in the next session, I will actually explain how we determine the KE, the 6.25%, right? So that you will have a clear picture of how you can figure out this number. You can actually Google it. Very likely, if you ask for the cost of equity of Starbucks and you Google it, you'll probably find a number that is very similar to what I have here. But again, next session will cover it, and I will show you how to measure it yourself. Okay. All right. So now we do have this $42.16. And again, it's a little closer to $74.29, but it's still like a stretch thinking that Starbucks is really, really overpriced by quite a bit, by more than $30 per share. So let's do this next. Let's look at the free cash flow. Let's look at the free cash flow. And again, this model was constant dividend, growing dividend. So let's go back to the database. Let's go back to CapitalIQ. For me, again, you can find this information anywhere you like. And let's go to the cash flow statement. And you'll see that I will be able to immediately find the levered free cash flow. And the levered free cash flow, the last levered free cash flow that I have available, the challenge here, you can see that the free cash flow, the levered free cash flow, is actually has been going down, right? It has been going down. And it was 3693, and now it's only 1226.7. So let me write down 1226.7. Okay, now let's go back to our Excel sheet. Excel sheet. Okay, all right. So now free cash flow model. So let me just copy and paste this. Okay, so instead of free cash flow, and so I know that my free cash flow is actually 1226.7. You can already see immediately that things are not going to get any better. If anything, they're going to get worse, because now my free cash flow per share, right, is actually only $1.05. Right, so this is my free cash flow per share. This is my dividend per share. So if anything, it has been going down. Right, so it's probably not going to work very well. Constant free cash flow. So I can just copy and paste this formula here. Since we have limited time, I'm trying to go a little faster here, but you can see free cash flow constant and growing free cash flow. Okay. All right. So now instead of using the so I'm going to do 1.05 divided by my 6.25, and there you go. So I get a price per share of only $16.80, which is probably not right, as you can see. And then if we have the growing version, right, we're going to grow it by 2.5%. and then everything divided by, again, I know what it was, I'm just going to write it in the formula here, 6.25% minus 2.5%. Okay. All right. So I get $28.70. Again, very unlikely that this is the right number. Now let's try to do it with the last methodology that I recommended. Let's go back real quick to the database and let's collect the earnings per share going to the income statement. So you can see the basic EPS excluding extra items, which is actually $2.85. $2.85. So let's write this down. All right, so let's go back to our Excel sheet. Okay, great. So let me write it here next to the dividend. So we have earnings, constant earnings. And so I'm going to write it here. So we have 2.85 divided by 6.25%. And now we get $45.60, which is a little better. And now we can try the growing earnings. Growing earnings. And I can anticipate that probably this is the best of the three models that we looked at that probably will give us something more reasonable at this point. So I'm growing this. And so divided by 6.25% minus 2.5%. There you go. Actually, we get a very good number here, right? A very good number. At least a number that is a lot closer to the actual price per share of Starbucks. Okay, so let me just use my pen so I can emphasize what we have done today, right? Because we're about to wrap it up here. So we looked at three different ways of pricing the stock. We talked about pricings versus valuing it, a particular stock, and we talked about three different metrics. So we used dividends, right? We use dividends. We can use free cash flow, right? Free cash flow, or we can use earnings, right? So we tried all three methodologies with Starbucks, right? We looked at the price per share of Starbucks. We realized that it was at $74.29. 29 cents, if I can write it. It doesn't let me. It doesn't let me. Anyway, 29 cents. And so now we tried to calculate it by using our different models. And so when we tried with the constant dividend, we came out with $24.68. And with the growing dividend, $42.16. There you go here. Now, again, it doesn't mean that the market is pricing Starbucks correctly, right? It could be that actually our model is better suited to do so. But again, it's unlikely that the market is wrong by so much, right? That would be my thinking at this point. Now, we try with free cash flow. We notice that free cash flow has been going down over time. So very likely this free cash flow is not the right free cash flow to be used going forward. In that event, we use the last lever free cash flow, the constant version, $16.80, and the growing version, $28.70. Again, a little too low. It's unlikely that this model is really telling us something concrete about the price or value of Starbucks. And finally, we looked at earnings. And again, we said earnings can be a decent proxy sometimes for free cash flow going forward, since free cash flow and earnings will converge over time. And when we do that with the constant earnings, we get $45.06. And with the growing earnings, we're actually very close to the current price of Starbucks. And we actually come up with $77.90, which would indicate that currently the stock, Starbucks in particular, is undervalued by the marketplace. All right. Well, I see a question. How does the cost of equity differ from a company like Tesla? Great question. So you can appreciate that 6.25% is actually quite low as a cost of equity. So Starbucks is an established company with many locations around the world. It's a company that constantly generates cash, and it's a lot more predictable as a company compared to Tesla. So very likely you can expect that Tesla cost of equity would be a lot higher compared to Starbucks. And again, next session, hold on that thought, because next session we'll have a chance to actually understand how we can come up with two of the ingredients that we use today in our models, which is the cost of equity and the long-term growth. All right, thank you again for attending. It has been a pleasure, and I look forward to our future sessions together.